Good morning and welcome to today's Premium Account Short Form Market Update for the 29th of January. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hine, current Managing Director of Investor Signals Global Equity Management. I have over 17 years of experience in the financial services industry as a licensed securities advisor. The format for today's presentation, it is a short form update, so it's a quick summary of the macro update or outlook that's impacting equities. We look at a select few stocks within the ASX top 50, and I talk about the option strategy and portfolio allocations as we head into option expiry tomorrow, and conclude with a short-term market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact me, Leon, at investorsignals.com. Up on screen at the moment is a graph of the Dow Jones. So in general, whilst we've had some, negative factors sort of buffering equity prices, predominantly coming through from the sell-off in emerging market currencies and some of the perceived risks that are sitting there with liquidity and problem loans within sort of the emerging markets. That's probably been the main reason for the most recent sell-off. But when we actually look at the US December quarter earnings that are coming through, they're certainly meeting expectations. The market's tracking at the equivalent of about $110 of earnings for the S&P 500 companies, which is in line with sort of where analysts have valuations, I suppose. It does place the US market up at around 18-19 times current earnings, but if we allow for earnings growth somewhere in the order of sort of 8 to 10% over the next 12 months in the US, on a forward outlook it puts the US back at around 15 times earnings, which where we consider where bond yields are, we're pretty comfortable that equities are still sitting in what we'd describe as a fair valuation range. I think the argument for rapid price appreciation from here is limited, albeit that over the next 12 months, if we were to get more of a synchronized global growth picture, equities could certainly head higher. But our base case, again, is that we consolidate across the next 6 months, and then eventually we do see more synchronized global GDP. So what that means for the domestic market is that we're sitting at around about a 4.5% dividend yield, and likewise on a forward PE valuation trading about 15 times earnings. Now, most of that growth is going to come through a combination of the US dollar earners, like the multinational companies that have a lot of US dollar earnings that will be converted back into Aussie dollars, will get sort of roughly a 10% plus uptick in earnings on the currency conversion side of things. And a lot of those names, the likes of Brambles, Amcor, Computershare, should deliver earnings growth somewhere between 5 to 10%. The resource sector should deliver EPS growth somewhere around 10 to 15%. And then we've got our sort of traditional consumer staples, Woolworths, Wesfarmers, that should deliver around 5% growth. So as the market sort of pulls back or consolidates at or near these levels at a 4.5% yield, generally your defensives trading down around 4.5%, up to your property trust trading around 5.5%, 6%. We still maintain that there's value, and it's supported by that sort of low backdrop of global bond yields, and domestically, obviously, with the RBA rates being as low as they are. So any sort of sell-off in our market down to even another sort of 5% below where it is at the moment, we think will be very well supported. Still maintain that over the next 6 months the market will spend most of its time trading at or near current levels. So let's go in and have a look at a couple of the stocks that we're positioning around. Option expiry tomorrow. So Transurban, we continue to like Transurban. We think that we'll see gradual increase in dividends here in Transurban over the next few years. It's currently on a yield of around 4.5%. We think it can trade probably up to around 7.25 over the course of the next 12 months. So we're buyers of it here at this level and selling the covered calls up at around the 7.25 level. The next div period for Transurban is around that June period. Telstra, also within this sort of defensive space that I'm covering initially, as it pulls back here anywhere around this $5 mark, we think it's a good buying opportunity. Puts the stock on a yield of around 5.5%. the dividend payments intact over the next 12 months, somewhere around 28 to maybe 29 cents. Telstra should grow earnings somewhere between 3 to 5%. I think a buy down here at around $5 with an eventual target up around 5.25 to maybe even as high as 5.50. But I think that certainly caps the upside recovery in Telstra over the coming say 6 months. Wesfarmers pulling back to around a 4.5% dividend yield, roughly around $41. We think it offers significant support. Up at around $44, we think it starts to get a little bit expensive. This is a name that we've took advantage of selling calls when the price was up high. We got almost $1.50 of premium for the 44s out into June, so it gives us an effective exit price up at around $45.50. They are European calls, so we collect the upcoming dividend as well. But again, I think Wesfarmers as a defensive asset should grow earnings somewhere around that 5 to 8%. And I think that sort of underpins the share price on any sell-off. So with buyers or wanting to continue exposure to Wesfarmers within the portfolio. As we are with Woolworths, just over a 4% dividend yield, should find support here at around $33. I think it can trade back up to around $34.50, but definitely needing to sell the covered call to complement that return there with Woolworths. A combination of that dividend and the call premium, we're driving around 12% cash flow out of Woolworths. And just finally, to finish off on the defensive assets that we're looking at, the ASX should grow earnings somewhere between maybe 1 to 3%. Again, down here at around a 4.5% dividend yield, we think the stock looks attractive. Could trade back up to somewhere around $36.50, but we've predominantly sold the covered calls at around the $37 level. They're European. We've collected the premium for those, and we'll collect the upcoming dividend, again driving in excess of 10% cash flow out of ASX. All right, let's have a look at a couple of the other names that we are interested in at the moment. Toll is getting back to our target here of around $5.50. We buyers of Toll at $5.50 on a 5.5% dividend yield, not expecting too much in the way of earnings growth. So at $6 we look to sell covered calls. The banking sector continue to like this as a theme of playing obviously the recovery in the Australian housing market and in broadly just the recovery in global GDP over the coming years. I think Westpac down here at around $30 is a buy. Up at around $33, $34, we start to look to cover calls. We expect to see sort of more upside momentum out of the banks over the coming months. Woodside Petroleum within the resource space continue to like this. We're happy with their production results at around a 5.5% dividend yield, about 8% earnings growth. I think Woodside could track back up to around $39, $40, but we don't see much upside above that. And likewise with BHP, we continue to like this name down here at around $35. I think with iron ore at $125 a tonne and the cutback in exploration costs, as I spoke about last week, the prospect of maybe seeing some type of announcement over the next 6 to 12 months around a special dividend should continue to underpin BHP, with earnings growth sitting at around 10 to 15%. All right, so let's move on to a couple of the property names. So WDC getting down here at back to a 5 and a little % dividend yield at $10. The stock should be well supported. So we continue to like Westfield as a property play. Likewise, Westfield Retail Trust. Obviously, we see the vote for WDC shareholders, I think, around May to approve the spin-off of the Australian, New Zealand, Australasian sort of property assets that will be spun out of WDC and merged with WRT. The WRT shareholders are pushing back a little bit at the moment, looking for a slightly sweetened deal. But broadly speaking, at around 5.5% dividend yield at about $3, we think WRT looks reasonably attractive. It's one of those names we're not looking for a lot of earnings growth. I think the company will be lucky in its current form to deliver sort of 1 to 3% earnings growth. At around $3.20, we look to sell the covered calls. GPT's probably has the most upside out of the property plays that we're exposed to at the moment. We've been buyers of this at lower levels at a 5.5% dividend yield. We think that the stock could trade up to as high as $3.80, but certainly looking at taking profit or selling calls up at that level. The other property name that we have exposure to is Stocklands. So down here at around this level, puts the stock back on about a 5.5% dividend yield. We think the company should deliver 5 to 6% EPS growth. Expect it to be well supported, sort of trading into the middle half of this year. And then finally, let's just quickly look at a couple of these US dollar plays again. So under option expiry tomorrow, we'll be delivering Amcor, where we own it at lower levels. In saying that, we're still happy to keep exposure to this lower Aussie dollar theme. I think a portfolio allocation where we're overweight some of the Transurbans, Telstra, Wesfarmers, Woolworths, ASX, and then we have exposure to still Aussie dollar plays being Amcor, Brambles, Computershare, some of those names. I think if we are to see any sort of sell-off in the market and the Aussie dollar comes under pressure, those names are going to benefit further from a lower Aussie dollar. So as a portfolio mix, having a combination of the defensive assets and some Aussie dollar or some US dollar exposed stocks, I think sort of makes sense. So even though we'll be probably delivering Amcor in tomorrow's expiry, we continue to watch it. It is expensive up at these levels, so our ideal entry price is back at around that sort of $10 price point. Amcor should deliver 10% earnings plus as a result of the lower Aussie dollar and the internal growth within the business, so expecting it to largely move sideways. Brambles should deliver on a constant currency basis about 7 or 8% earnings growth, allowing for some improvement from the lower Aussie dollar. We could see 10 to 12% EPS growth for Brambles. The stock is expensive up here, trading about 18 times earnings on a 3.5% dividend yield. But again, we continue to keep exposure to it over the next 6 months on the basis that I think it can largely trade sideways. AZJ, we own this at lower levels. It's had a little bit of a sell-off, but not a lot over the last few days. I think it can trade back up to around 510. We look to sell the 525 calls over AZJ. Computershare, we deliver under option expiry tomorrow. As I mentioned, I continue to like Computershare with about 5 to maybe 10% earnings growth over the next 12 months. Somewhere at around 10.50, the stock certainly becomes attractive, and we'd look to continue our exposure there. Now, one of the themes I just wanted to finish on today was the oil and gas sector. So Oil Search has come out with production numbers that have exceeded analysts' expectation, about 10% ahead of market forecast. So that's why we've seen Oil Search hold up relative to the other names. I think over the next 12 months we could see Oil Search trade back up to around $9.50. So we're buyers of it down here at around $8 and holding it on a move back up to around $9. Santos, we're not adding exposure to Santos at the moment. We've taken profit some months back when Santos was at higher prices. You can see here the value range that we highlighted, and that was put in place many months ago, where we're looking for Santos to pull back. So maybe down here on a consolidation around $13, we start to have another look at Santos. But right at the moment, Oil Search and Origin are probably our two picks, although we recognise that Origin is not seeing a lot of earnings growth short term, when I say that over the next 12 months. But on a 3.5% dividend yield, 4% dividend yield, we think that on a sort of 2 to 3 year outlook, Origin can deliver value, but over the next 6 months it's bouncing sideways, so we're trying to sell the covered calls up at around the $15 level. And then finally, obviously within sort of that broader resource spectrum, we still maintain that BHP and Woodside Petroleum are our preferred overweight positions. Just to conclude again with a short-term outlook, so our base strategy is to keep exposed to the defensive names within portfolios, sell the tight covered calls, keep exposure to the US dollar earners, and then be quite selective around where we see short-term capital growth opportunities driven by sort of market timing events. So looking to buy into some of these names that I've mentioned in today's recording during any weakness that we see, hold them for a week or two as part of what we see as a broader ongoing recovery off sort of this current sell-off level, and then sell the covered calls. Thank you for listening in to today's recording. I look forward to speaking again next week.